Traders, today we are going to go through a fantastic zigzag example from the Elliott Wave Theory that is going to change the way you see the markets. Always, when we are looking for finding the end of a corrective wave, we are going to start adding tools like Fibonacci levels or other levels, support and resistance from previous highs or lows, and of course, that's not going to work. The most powerful setup that you can use in your trading is following the trend. When you try to go against the trend, when you try to fade the trend, most of the times that's going to fail. And it's easier to go with the trend. But the next question is how to do it, and how to do it properly, and how to do it with the Elliott Wave Theory. So today, I'm going to explain a step-by-step the ideal setup when you want to find the end of a zigzag in order to jump into the trend with a low risk and a high probability. So let's start. We are going to start with the basics. The zigzag is a pattern that happens after an impulse. An impulse in the Elliott Wave Theory is a 5-wave sequence. The zigzag shows up in different shapes. A common mistake is trying to guess where the end of the zigzag is going to happen, because technically the price is moving down and you are going against this trend. So you have to be extra careful with your zigzags, because a lot of traders make a lot of mistakes trying to find the end of the corrective wave, like adding Fibonacci levels and trusting those levels, which don't make any sense, are extremely subjective, and are going to make you lose a lot of money. If you like to use them, that's fine, of course, but you can add the technique that you are going to learn today to make that setup even more powerful. I promise this is going to change your way of trading zigzags forever. Let's start with our exercise. This is a second wave on the S&P, and we are finding the end of the second wave. Let me ask you something. Do you believe this is a good buy trade? Yes, no, and why? Type in the comments below your thoughts. Share with me what you are thinking about this setup, because this is a great exercise that can change your trading. Right, so you can pause the video, go to the comment area, and type whatever you think. If you buy it, if you sell it, if you wait. I believe that this is a really bad trade from my point of view, because the candle is huge, and we don't want to go against these type of candles. We want to go against the slow candles. So in this case, I'm not going to try to do anything. Here, when I'm live here, and this is a real case because in the membership, in the Elliott Wave Street membership, this is a trade that we follow this week. But in this case, I will be expecting for something deeper, after this momentum. Well, the price reversed, but it's a bad trade. It's a bad trade because the plan is that you are going to repeat and repeat the process, right? So of course, this is something that you are going to avoid. Don't go against these fast and huge candles. Wait. Now, look, we have a second chance to start working in our setup. The price builds another wave 1 and another zigzag. Please have a look at the difference between this zigzag and this zigzag. Clearly, is different, right? It's absolutely different. We have here an ABC. We have here an ABC. So both have an ABC, but the shapes are completely different. On the second case, the C leg is more shallow, is lower than the C leg on the first example. We are having some tails, which that's fantastic because it's absorption, and we can see the price rejecting the low. Plus, we have a demand candle. We have a complete course in the Elliott Wave Street about supply and demand included in the memberships. So if you want to learn about these candles, to find if it's supply or demand, we have that great course there for you, because that's the trigger. So after the demand candle, we can trigger the trade above that candle if the next or the next candle moves above that high. The protective stop loss could be just a couple of ticks under what we believe is the end of the second wave, because leaving it here is too much, and we need to trade with a smaller stop loss because the risk-reward ratio is going to be better with a smaller stop loss. So the target, traders, is going to be the previous high. Talking about liquidity zones, when we have a move up and a retrace, the liquidity area is here and the liquidity area is here. And the market is going there or is going here, right? One or the other. And we need to pick a side. If we pick that the market is likely to move above this area here, we will be buying. If we think that the market is going here, we will be selling. Of course, with Elliott Wave, we can pick the side. We can choose which side we want to trade. And in this case, we're following the trend. So, of course, we want to buy it. And in this case, we're seeing a slow price moving down. So that's another important aspect when we are finding which side we want to trade. And of course, we pick this high here as the minimum target for this trade. So it's a 50s point trade. The price starts moving, regular movements, up and down. And finally, the price moves up and hits the target. When we have a breakout like this one, we can hold part of the trade. I'm from the school of booking partial profits during the road, just in case, because in these markets, anything can happen, and that's a market reality. So it's better to take out a part of the trade during the road, just in case. And the price continues, and finally, it came back to the 50.48. For the first time in history, the S&P is reaching higher highs and is reaching new record highs better. And it seems that this is likely to continue, so don't try to sell it. I think that that's not our job. Our job is not finding when the S&P is going to turn around. That's too complex and nobody knows. But something that we know with a higher probability is that after every good discount, every zigzag, we can follow and we can have good trades. So if you master how to trade the zigzag, how to pick the best zigzag, and then you start practicing on any time frame and any market that you like, you are going to start seeing the results. But if you are trying to fade the trend, if you are trying to find the end of the trend, if you are trying to sell every high or every divergence or whatever you are seeing, you are going to lose a lot of money on the longer term. I believe it's better to follow the trend, but you need to have a technique to follow the trend. And that's something that you can learn with us, and that's something that you see that works, and that you can, if you join our group, our trading group, you are going to have a lot of value because you are going to see every day these strategies in action. So traders, the next step to learn all these little details and to practice and to have all the details, to master all the details, visit ElliottWaveTheory.com. Under the membership tab, you're going to see our plans. We have the Forex, the stocks, and the full access. Here are the list of instruments that we cover on a daily basis, and you will get access to the Discord server as well, and you will get access to courses like the price action course, the volume profile course, the Elliott Wave crash course, the candlestick for Elliott Wave traders course, and more. So join us today just for $19 the first month, and then $75 per month. Pick your plan, and you will get immediate access to this fantastic Elliott Wave world of opportunities, of setups, of techniques to find the end of the waves and to find the best trades with the lower risk. Have a fantastic start of your trading week, of your trading session. I'll see you soon. Take care. Bye-bye.